Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi dan salam sejahtera. Thank you everyone for attending this virtual press conference where we will be sharing our third quarter GDP performance. And as usual, with me are the colleagues from DOSM, Department of Statistics Malaysia, who are the official compilers of the GDP numbers. Growth rebounded across most major and regional economies as nationwide lockdowns and travel restrictions were largely relaxed. In the advanced economies, a rebound in private consumption contributed to the better growth outturn. In the regional economies, growth was supported by the resumption in manufacturing activity and exports. Firm control over the transmission of COVID-19 locally led to the resumption of private sector activity in the economies. The recovery was particularly pronounced in China, which recorded positive growth of 4.9% during the quarter. Consumer demand and public investment were key drivers of growth. Domestically, underlying economic activity was also on a recovery path since the trough in April 2020. This was evident from the high frequency indicators that are pointing towards a rebound in external demand and continued improvement in business activities as well as household spending. Now, let me hand over the presentation to Dr. Sri Uze, who will provide a brief overview of the third quarter GDP performance as most of the details would be flashed in the various DOSM social media. Datuk Sri Uze will also share the components of the GDP data. Datuk Sri Uze, will you please?
Department of Statistics Malaysia DOSM will present the highlights on Malaysia economy performance for the third quarter of 2020. In the third quarter, Malaysia GDP growth rebounded significantly by registering negative 2.7% from a sharp decline of 17.1% in the previous quarter. The economy performance during this pandemic period is also measured on the monthly basis, where the GDP in July declined to 2.7%, August negative 3.6%, and improved to smaller negative 1.6% in September. With this performance, the monthly GDP has shown continued improvement since the trough in April. The monthly GDP compilation was initiated by DOSM to provide more frequent statistics to gauge the Malaysia economy performance. Thus, this statistic would be useful to users, especially policymakers, to gain insight of the overall economy. Ladies and gentlemen, the further relaxation of the movement restriction was observed worldwide has led the increase of overall global demand. This performance also contributed from the stimulus measure implemented by the government. To proceed, I will brief the performance by main economic activities. On the supply side, economic activity improved across most sectors as Malaysia is containment measure in the third quarter. On manufacturing, the manufacturing sector rebounded 3.3%, backed by stronger external demand for E&E and medical-related products. Furthermore, domestic-oriented industry also posted an improvement due to increase of domestic demand. On agriculture, the agriculture sector recorded a marginal decline weighted by slower growth in the oil palm subsector. However, livestock and other agriculture subsector grew 2.0% and 5.0% respectively. On services sector improved to negative 4.0%. This performance was mainly attributed to continued recovery across all subsectors post-MCO. The improvement in services sector was mainly due to the better performance in finance and insurance and information and communication subsectors. On mining inquiry sector registered a smaller decline of 6.8%. This performance was mainly attributed by the improvement in production of natural gas and crude and condensate following the increased demand for oil and gas. Finally, on construction sector recorded an improved performance of negative 12.4%. This was attributed by the resumption of more projects across all subsectors in which specialized construction activities rebounded. To give more insight on the production side, the unprecedented period caused by the COVID-19 pandemic has affected the efficiency of the production capacity, whereby some industry had to bear a fixed expenses on input, but experiencing a decline or slower output. This had caused the increase in the input-output ratio or production efficiency, which subsequently marginalized the value added. Ladies and gentlemen, now I will brief on the performance of the demand side. All components on the demand side recorded a significant recovery. Private consumption recovered significantly, supported by the gradual recovery in broad income condition amid resumption of economic activities. The performance was also lifted by the implementation of the stimulus measure such as BPN, BSS, and API Lestari. Expenditure on basic necessities such as food and non-alcoholic beverages, housing and utilities, and communication remain strong. Meanwhile, investment by both the private and public sector pick up markedly, particularly from better structure investment benefiting from the resumption of the construction activity. Public consumption expanded to 6.9%, supported by higher government spending on supply and services. On the external front, net export rebounded to 21.9%, attributed to faster recovery in export. This in line with the recovery in the external demand. DOSM will continue to monitor and measure thoroughly the current economic and social performance for the coming month. And the department also will be releasing the Malaysia Economic Statistic Review, Volume 7, in the end of November 2020. With that, I end my presentation. Thank you. Hand over back to Dato' Gamna, please. Thank you.
Thank you, Datuk Sri. Let me touch on trade, which has been a key support to the improving growth performance. As Malaysia is a highly open economy, with trade accounting for more than 100% of GDP, the improvement in the global economy continues to underpin our economic recovery. In the third quarter of 2020, higher demand from key trade partners has resulted in gross exports, rebounding to grow by 4.4% in the third quarter. The recovery in exports performance was driven by higher E&E exports, given strong global demand for work-from-home equipment, servers, and medical equipment. As a result, the current account of the balance of payment registered a higher surplus of 26.1 billion ringgit, or 7.1% of GDP during the quarter. With the reopening of the economy and normalizing demand conditions, the labour market has also shown improvements. Employment growth registered a smaller contraction, while the unemployment rate declined, supported by positive rehiring activity. In addition, the placement rate of retrenched workers into new jobs continued to improve in the quarter and into October, amid a decreasing trend in workers applying for jobless claims. The steady improvement in overall labour market conditions, particularly income, provides fundamental support to the recovery in private consumption. This is validated by the latest wages and sales indicator. In addition to income, less stringent mobility restrictions relative to the first half of this year, and continued policy assistance are also expected to support household spending going forward. The outlook going forward remains subject to downside risks. In particular, the primary downside risk to global growth is the resurgence of COVID-19 cases, leading to a reintroduction of containment measures. However, the risk to growth from these resurgences is not expected to be as severe as the magnitude of the contractions observed in the second quarter. On the domestic front, this is also a risk to our growth prospects. The targeted containment measures could weigh on economic activity in the affected states. However, the current targeted CMCO is not the same as the previous MCO. Almost all sectors are allowed to operate, while households and businesses are able to adapt quickly to SOPs. Policy response is also gaining traction in supporting the economy. As such, we expect the impact will be less severe than the second quarter. This is also corroborated by several high-frequency indicators, which suggest that consumer spending is less affected now compared to the second quarter. I wish to share an interesting statistics. 2 days ago, on 11/11, online transactions in Malaysia hit a record high of 3 million ringgit transactions, well above the normal daily average of about 1 million ringgit transactions. This tells us two things. One, the digital retail revolution is gaining momentum. And two, this also suggests that people are still spending. The impact of the recent CMCOs on 2020 real GDP is about half of the impact of the MCO in the second quarter of 2020. During the CMCO implementation period, the daily impact is estimated to be about 0.3 billion ringgit. Going into 2021, the Malaysian economy is projected to recover and grow within the range of 6.5% to 7.5%. This projection is also in line with other multilateral institutions such as the IMF and the World Bank. Growth in 2021 will be driven by a rebound in global demand. Malaysia's key trading partners are projected to register better growth prospects in 2021. The higher external demand will have positive spillover onto export-oriented industries in the form of higher income and investment activity. Moreover, gradual normalization in economic activity would promote strengthening in employment and income prospects and support consumer spending. Investment activity is also expected to rebound, supported by strong investment intention, with certain segments and continued implementation of large infrastructure projects. Finally, growth for the next year will be further lifted by higher production from existing and new facilities, particularly in the commodity and E&E subsectors. Several forward-looking indicators are already suggesting firm support for trade and business activity. Industry forecasts suggest that global demand for E&E products to improve significantly in 2021, as reflected by a pickup in new export orders. The continued increase in early-stage construction work suggests a recovery in domestic investment activity. The 125 basis point policy rate reduction this year to a historical low of 1.75% in 2020 will continue to stimulate growth next year. This has eased the debt service burden for borrowers and supports financing activities. Future monetary policy considerations will continue to be guided by evolving conditions and their implications on the outlook for inflation and domestic growth. Beyond monetary policy, other targeted policy measures will continue to provide support to the vulnerable segments and the overall economy. These include various measures aimed at preserving employment and upskilling current workforce to facilitate redeployment to higher skill jobs and cash flow relief to households and businesses. Turning to inflation, headline inflation recorded a smaller negative during the quarter, due mainly to the increase in domestic fuel prices. Meanwhile, core inflation moderated slightly to 1% amid lower rental and accommodation inflation. In line with earlier assessments, headline inflation is likely to average negative this year, given the substantially lower global oil prices. Going forward, headline inflation is expected to average higher in 2021, in line with the recovery in global oil prices. Core inflation would remain subdued amid continued spare capacity in the economy. The inflation trajectory, however, would continue to be determined by global oil and commodity prices. This QB also features a box article titled Understanding Deflation. Deflation refers to the persistent and broad-based decline in headline inflation. The current episode of negative headline inflation is not outright deflation, as it primarily reflects the impact of lower global oil prices, and this is not unique to Malaysia. A holistic assessment on deflation requires consideration of underlying inflation dynamics, the behavior of inflation expectations, and the wider economic environment. In the case of Malaysia, price declines in the CPI basket are not pervasive and inflation expectations remain well anchored. Propagation mechanisms of deflationary pressures are also relatively contained. For example, there is sustained credit intermediation, while relief measures help to contain defaults. Domestic financial market conditions continued to improve during the third quarter, driven mainly by positive investor sentiment following signs of recovery in global economic activity. As a result, non-resident flows into the domestic bond market continued into the third quarter, partly contributing to the lower bond yields and an appreciation of the ringgit against the US dollar. The lower bond yields also reflected further reduction in the OPR in July 2020 by 25 basis points. The equity market, however, recorded only marginal improvements during the quarter, following the global equity market correction that occurred in September. This was due to concerns over the potential materialization of several global risk events. Going forward, volatility in domestic financial markets will continue amid lingering uncertainties. The bank will monitor market developments closely and continue to ensure that conditions remain orderly. Broad improvements in financing conditions continued since June, with faster expansion seen in outstanding loans and corporate bonds, where it grew by 4.7% and 4.3% respectively. The loan expansion was mainly supported by household loans, which grew 5.6% on an annual basis. While business loans registered a more modest growth, there is sustained recovery in loans disbursed for investment purposes. Despite the slower growth in business loans, disbursements was sustained during the period, reflecting continued financing support from banks. While Bank Negara Malaysia has upsized the funds for SMEs to 21 billion ringgit, the funds reflect only a small share relative to the total business loans disbursed by the banking system. The bank has undertaken a number of measures to ensure there is sufficient liquidity to support intermediation activities. These combined measures have resulted in additional liquidity of 59 billion ringgit since March 2020. Total liquidity has remained stable around 146 billion ringgit as at end September, with 118 billion worth of placements with the central bank available to be released at any time. The bank will continue to closely monitor the liquidity conditions in the domestic banking system and ensure orderly market conditions conducive to support financial intermediation activity. The resilience of our financial system has enabled banks to provide continued repayment assistance to SMEs and households during this challenging period. This includes extension of moratorium to the most vulnerable groups. As announced in Budget 2021, moratorium extension and installment reduction has been further extended to B40 and micro enterprises. But let me stress that the assistance by banks continue to be available to all borrowers and is not limited to B40 and M40 only. All banks have developed assistance packages that can be tailored to the specific circumstances faced by all viable customers. Banks have also sought to make the application process as simple and efficient as possible. At the same time, many non-affected and less affected borrowers across different segments are observed to have resumed loan repayment. This is evidenced by the increasing value of loan repayments of 81% as at end September compared to levels seen prior to the MCO. A survey among banks also shows that 85% of borrowers have already resumed repayments by end October. Around 43% of loan repayments among individuals are coming from borrowers earning less than 5,000 ringgit a month, which would include those in the B40. Since the budget announcement, a lot of discussion about the targeted repayment assistance have been swirling around the public, leading to a lot of misconception on the TRA. Let me clear the air by firmly dispelling this misconception that without a blanket moratorium, borrowers in difficulty will not get help. That is simply not true. Help actually remains for those who needs it. There are other misconceptions about the TRA, and we are sharing the correct information here for reference of the public. Bank Negara Malaysia is establishing a new Targeted Relief and Recovery Facility, or TRRF, with an allocation of 2 billion ringgit. This facility will be open for applications on 1st December 2020. This facility will provide relief to and support the recovery of eligible SMEs in the services sector that are adversely affected by the reintroduction of containment measures since June 2020, with the exception of tourism and tourism-related services subsectors, which are supported by the existing Penjana tourism facility. Recognizing that high-tech sectors and innovation-driven firms are key to realizing new growth opportunities, Bank Negara Malaysia will also establish a 500 million high-tech facility to support affected SMEs in high-tech sectors that fulfill the national investment aspirations. This HTF will be open for applications in mid-December this year. The targeted high-tech sectors include air and spacecraft, basic chemicals, and biotech pharmaceutical subsectors. Bank Negara Malaysia will also be increasing the available allocation of the existing micro enterprise facility to 200 million, where the current available balance is about 85 million. This supports micro entrepreneurs and the self-employed, including gig workers on digital platforms and the self-employed. The increased MEF allocation will also support the expansion of the iTekat program. Let me now conclude the briefing. The Malaysian economy improved significantly in the third quarter. While the targeted CMCO could weigh on growth, the impact is expected to be less severe compared to the second quarter of this year. Going into 2021, growth is expected to be supported by a pickup in global demand and normalization in domestic economic activities. Downside risks to growth remain, mainly from developments of the COVID-19 pandemic globally and domestically. The bank will continue to closely monitor these risks and their implications on Malaysia's growth trajectory. However, not all is gloom and doom. The recent promising news on the potential vaccine for COVID-19 would present an upside to growth. More importantly, policy support and assistance will continue to be available to both businesses and households to weather this challenging period.